Hi, and welcome to everyone who's joined nice and promptly and early. Yeah, as you can see, know the time, it's still early. So we're going to, let people join and then we'll see everyone again in 10, 15 minutes.
Let me hold on a second. I'm just going to talk to Danny. And we'll try and sort it out for you. Hold on a sec. Danny? See, if I send you the link, I'm going to send you the wrong link. I want him to send it. So let me just try and get hold of him. I'll call you back if there's any problem, but we should send it to you in the next few minutes. All right. We're only going to start at once. So we've got about 10 minutes. We'll sort it out. Okay. Thanks, Kumar. Thank you. Bye. Bye. Danny? Oh, okay. Wonderful. Thanks. Right. Okay, as long as you can get in, that's fine. If you've got a problem, you can give me a call. It's fine. Okay, sure. Thanks. Bye. Bye. Good afternoon, everyone. Thanks for joining us. We're waiting for everybody to join, so we will start a few minutes late, probably no later than 5 past. So just time to make a cup of coffee or get ready, and we'll join you. We'll start as soon as we reach a tipping point. So most of the people are in, but it is taking time to. There are a lot of registrants, and it is taking time to join. So thank you. Good afternoon to those who just joined. We are running a few minutes late because people are still joining. So if you don't mind, we'll start at 5 past, just to give everybody a few extra minutes. Thank you. Afternoon, everyone. All those who have joined, we'll start in exactly 1 minute. Just waiting for everybody to join. Those that join late will just I can refer to the notes. So just at 5 past, we'll start. That should give everyone enough chance to tune in. You've got a minute in which to make that cup of coffee, and then we'll hand over to Jackie. So just waiting a few more seconds.
I'm just curious. I've tested a new function of live transcripts and subtitles. So I don't know if anyone can see that. A new AI tool, and that's for those who need.
Not too sure these days if intelligence is artificial or otherwise.
No. I just saw an article. It was a competition for who can use the AI tool to generate images to win the competition. But someone entered with their normal everyday photography that just looked very odd and won, but then they were disqualified for the fact that it was an actual photo and not artificial intelligence.
Yeah. The Princess Kate, victim of that one. Okay, so now it's 5 past. Thank you for joining us on this summer's day in almost summer's day in Johannesburg, and look forward to a pleasant afternoon. Jackie Arendse, of course, needs no introduction, and so here we go with the mid-year tax update. And Jackie, as usual, you can entertain us for the next 3 hours. If you want to have a break, Jackie, at about 2:30, I guess that would be more or less where we would break and have a body break and refreshment, and we'll come back after that. So if that's in order.
Great. Yes,
the floor is yours.
Well, okay, so 2:30, we'll take, what would you like, a 20-minute break? 15-minute break?
It's up to you.
Okay. All right, well, maybe
All right.
make it 15 minutes,
Okay.
just in the
Perfect.
interest of time, because I'm sure everyone would also like to get finished without too much delay. So yeah, 15 minutes normally works quite well. So let's go with that, if that's okay. All right, super. So good afternoon, everyone. It is wonderful to join you again. I think last time I spoke to you as a group was with the budget speech update in March. And here we are, 19th of June. Wow. I mean, June is just flying past, and not too much longer until the winter solstice, and then the days start getting longer again. So that's great. Yeah, we got a busy agenda this afternoon. So being the mid-year update, we are just kind of covering the major developments in terms of the case law, and then just some relevant things as they stand right now. There is so much to cover in tax that it's impossible to sort of do a general overview of everything that's happened in 3 hours. But we'll do our best just in terms of talking about the case law judgments, and you can see there's quite a variety there, and then some of the recent SARS documents and notices that I just would like to bring to your attention. So we're going to spend the first part talking about case law, and then we'll probably still cover a couple of cases in the second part, and then also obviously finish off with all the SARS documents and notices in the second part of the presentation. And as always, if you have any questions, I think the easiest is to pop them into the chat box. I have the chat open on my other slide here. So don't worry, I'm not getting distracted watching tennis or anything like that. I'm just looking at the chat box from time to time to see if there's any questions. So if you have any questions, please pop them into the chat box, and we will deal with them. Or depending on how it goes, I will leave it until the break and then pick up on questions during the break. All right, so as you can see with the case law judgments, we've got one Constitutional Court judgment, one SCA judgment, 2 High Court cases, and 1 tax court case. I mean, there've been a lot more tax court cases, and they are all really interesting, but we could be here all day talking about tax judgments. And I think I've just chosen this one here dealing with transfer pricing, obviously quite a significant and interesting area. And this is the first real judgment that we've had dealing specifically with a transfer pricing issue. And I'm sure it's the first of many still to come. If we look at the trend internationally, transfer pricing is really a huge area of tax risk for multinational operations. And we'll get into how transfer pricing works. I'll do a brief overview and then we'll have a look at that case. But also looking at the subject matter of the various cases. So we've got the Capitec case dealing with VAT, EnviroServe, the good old 12C manufacturing plant machinery allowance. It's a very interesting case, I think, that one, especially in light of the current issues around environmental matters and so on. And then interest, which is always a topical matter, and that's in the Unitrans case. And then the Walter case dealing with gross income restraint of trade payment. Then, of course, as I mentioned, the transfer pricing issue in ABD Limited. Interesting, I just noticed that all of these have the taxpayer being the appellant and SARS being the defendant. Not too surprising with the Capitec case, because I think we have seen quite a trend in recent years of taxpayers taking the SCA decisions on appeal to the Constitutional Court at a rate greater than I think any of us thought was going to happen. But we are seeing that quite often in the SCA, and I'm just about to contradict this statement, but often in the SCA, we see that the outcome tends to go in favor of SARS. With the EnviroServe case, the one that we're going to be talking about that is from the SCA, we actually see a different outcome. But in many cases with the SCA, it seems that it goes in favor of SARS, and then the taxpayer ends up having to take the matter on appeal to the Constitutional Court. And so with the Capitec Bank case, this one dealing with VAT, and it's kind of VAT input tax, although you'll see that in the judgment, they make clear that what Capitec is claiming is not really an input tax per se, it's a different form of a deduction against output tax. And even with that statement, it just illustrates how complex the VAT legislation actually is. I think at one level we could say, well, VAT is a difference. Output tax minus input tax leaves you with whatever is the VAT payable or refundable. But within that very simplistic framework is an incredibly complex piece of legislation. And it's often in the technicalities that one comes a little unstuck. If you're not 100% familiar and with the legislation, how it is structured, what the different definitions are, and what the specific criteria are to fit within certain provisions. I mean, just think about all the cases we've had dealing with, zero-rated suppliers where the taxpayer thought they were eligible for zero rating, for argument's sake, and then it turned out that they actually had not met all the conditions necessary for that. So the VAT Act, yes, it is a very complex piece of legislation. It's a significant area of tax risk in any business, from small to mega large. I think VAT is probably one of the main areas of tax risk. Well, obviously, if we take the international tax out of the equation, because we're going to come to transfer pricing just now, and then we'll say that's a major area of tax risk as well. But of course, there's a number of aspects with tax that one has to consider when you are looking at your tax risk and your tax risk strategy. Well, let's have a look at the Capitec Bank case. And from the Constitutional Court, as I say, and judgment handed down earlier this year. And it is dealing with the Value Added Tax Act. And it's looking at a supply that is made free of charge. So there is a supply, but there is no consideration for the supply. And the question is whether that would constitute a taxable supply. Now, I'll give you the background to this just now, but the specific provision that Capitec was looking at was Section 16(3)(c). Now, if you know your VAT Act, you know that Section 16 is where the input tax provisions sit. And so that Section 16(3)(a) and B talk about claiming your input tax credits, where you've got VAT paid on expenses and the acquisition of goods and services that are going to be used to make taxable supplies, right? Now, 16(3)(c) is a very specific deduction provision, allows a deduction against output tax. And I'll give you the exact provision just now. But the question here was whether the supply of an insurance contract to borrowers who pay interest and fees was made exclusively in the course or furtherance of an exempt activity. Could Capitec get the deduction under section 16(3)(c) or not? So the one thing is that if you don't have a supply, if you don't have a taxable supply, then you're not going to get this deduction. So this will all make a lot more sense when we start going into the detail of the case, but just to put the questions out there at first. And then the other one was whether the input tax or this deduction under section 16(3)(c) could be apportioned if the insurance contract is supplied partly in the course of an enterprise, which is interesting. Usually we talk about supplies, taxable supplies and exempt supplies or non-supplies. So we talk about a mixed supply situation, which would lead to an apportionment of input tax. That apportionment happens under section 17 usually. But here the question is whether we would look at an apportionment within section 16(3)(c). If you've got a supply only partly in the course or furtherance of an enterprise. Interesting wording. We'll come back to that. And then the issue here also was that Capitec really adopted an all or nothing approach. In fact, they adopted an all approach, okay? They said, we want it all, we want the whole deduction under section 16(3)(c). And they did not give apportionment as an alternative. They simply said, the objection to SARS assessment was that they want the full deduction under section 16(3)(c). They didn't ask for apportionment. And so the court then had to consider, well, if apportionment is appropriate, can they grant or instruct SARS to make an apportionment if the taxpayer had not included that as one of the grounds of appeal? So we'll come to that one just now as well. So quite a complex case. The background to it is that Capitec is a bank. Obviously, we all know what Capitec does, well, pretty much. And they are a retail bank providing banking services such as transactional banking, which includes savings and credit card facilities. And the key thing is, in terms of this case, is that they provide unsecured lending facilities to their customers. All right, so they advance loans to their customers, and they've really grown their business massively over the last few years, focusing on this, especially unsecured lending. Now, this input tax deduction, let's call it that, relates to the unsecured lending business, whereby Capitec at that stage, when the facts of this case arose, they would provide insurance cover to their customers. So they would advance credit through these personal loans to the customers under loan contracts, and the loan contract, the standard loan contract, would provide the customers with loan cover, insurance cover to basically indemnify the repayment of that loan account. And so what would happen is that if that customer was unable to repay the loan account because of ill health or being retrenched or dying possibly, then the insurance cover would pay out. And the way it would work, the insurance cover was underwritten by Guard Risk Life and then another company as well. But if there was a reason for payout, the payout would come from the insurance company to Capitec and then from Capitec to the customer. All right. So Capitec would make this indemnity payment, if you like, to the customer, who would then use that money effectively to repay the loan account. And so it was this payment of money, let's call it the indemnity payment, that Capitec made to the customer. In that payment would be the section 16(3)(c) application. And Capitec would seek to claim the input tax or the tax deduction through section 16(3)(c) on the basis of that payment that went out to the customer. So they did pay premiums to the insurer who underwrote these loan cover contracts. But as I say, on payout, the cover would come from the insurance company to Capitec, from Capitec to the customer, and then that would then repay the loan account. I'm probably making it a bit simplistic, but in essence, that is what would happen. Now, how is it that Capitec looked at claiming the deduction under section 16(3)(c)? Well, as I mentioned, in the VAT Act, if you have a look at section 16, and it talks about the deduction of input tax, and obviously there's quite a few sub-paragraphs to section 16, but especially 16.3. So section 16, just to put it in context, starts off calculation of tax payable, all right? And then it provides the framework of saying we take our output tax and then we can claim certain deductions against output tax. In section 16.3, we've got subsection A and B, which talk about the deduction of the input tax that you've paid on your expenses and your acquisition of goods or services. A talks about on the invoice basis, B talks about being on the payments basis. And then we come to section 16.3c, which is a unique provision. And it says that we can also deduct, all right? So we're busy talking about the amounts that can be deducted from your output tax. And it then says we can deduct an amount equal to the tax fraction of any payment made during the tax period by the vendor to indemnify another person in terms of any contract of insurance, provided that this paragraph will only apply where the supply of the contract of insurance is a taxable supply. And it goes on, but that's really the part that is relevant here. So in the backdrop of what I explained around what Capitec was doing, when there was a payout from the insurance company to Capitec, and then Capitec paid the customer this indemnity payment effectively, then Capitec would say, well, we now want to claim the tax fraction of this payment made by the vendor, in this case, Capitec, all right, to indemnify another person in terms of a contract of insurance. In the underlying cases, there was the question as to whether this case could only apply to an insurance company carrying on an insurance business. But here it's clear that Capitec is the one. They're not in the business of providing insurance. They're a banking company. But in the course of providing banking facilities to their clients, they also make these loan cover insurance contracts available to their clients. And so they would be looking at paying these indemnity payments to their clients, their customers, and then they wanted to claim the tax fraction of that amount. But notice that this will only apply if the supply of the contract of insurance is a taxable supply. That's the key aspect here. And it links back to the highlights that I was giving you, the sort of overview of the case, saying that what if there is no supply, or what if it is an exempt supply? Then you obviously can't claim the deduction under this particular provision. So if we look at what was actually going on here, during the tax period, Capitec received payouts from the insurance company, and they made corresponding payments to their customers of 582 million rand in loan cover. And at that stage, during the tax period that triggered this dispute, the VAT rate was still at 14%. So if you apply the tax fraction, at that point, 14 over 114, multiplied by 582 gives us the 71 million rand, which they wanted to claim as this deduction in terms of section 16.3c. Okay. And basically, the dispute hinged around whether they could claim this deduction or not. Obviously, Capitec felt that they were entitled to this deduction. SARS said, no, you are not entitled to the deduction because the loan cover payments did not qualify. The supply of the loan cover did not constitute a taxable supply. And going back to this proviso over here to say that this deduction only applies when the supply of the contract of insurance is a taxable supply. They said this is not a taxable supply because they said Capitec is making this loan cover available to its customers at no consideration. Now, in terms of the contracts that were signed between Capitec and its customers, indeed, there was it provided that if you take a loan with us, we will provide you with this insurance at no charge. All right, so it's true they didn't charge any consideration for the loan cover. So SARS said, well, if there's no consideration, then there's no taxable supply. And they said, furthermore, that this loan cover is supplied in the course of providing credit to the customers, which is actually an exempt supply. Now, of course, when you talk about exempt supplies are listed in section 12 of the VAT Act. And we've got financial services, which are then defined in section 2. And certainly, if you advance a loan to a customer, you charge interest on the loan, that is an exempt supply. So a business like Capitec would get mixed supplies because they would get income from banking transaction fees, which is a taxable supply, and they would get income from interest on their loans, which is an exempt supply. So if you were talking about a normal cost, overhead cost to Capitec, like, if they're going out buy stationery to use in their head office, you would have to apportion the VAT paid on that stationery in the proportion between your taxable supplies and your exempt supplies, and they would only get the input tax related to the taxable supplies, right? Which in Capitec's case made up pretty much 90% of their total income 90% of their total income was exempt supplies in the form of interest. Only 8 to 10% was taxable supplies in the form of their bank service fees. So the question is that this loan cover that is provided to the customers, is that something that gives rise to a taxable supply? Or is it that because there's no consideration, there is no taxable supply, and on the other hand, it's linked to advancing loans to customers, and therefore it's an exempt supply? Or is it a fully taxable supply, or is it something else, a mix between taxable and exempt? So Capitec said they're entitled to a full deduction. SARS said you're not entitled to any deduction at all. So they're each standing at each end of the scale, no middle point at this stage. And as far as the SCA was concerned, and this was the judgment handed down in June 2022, which Capitec subsequently appealed against through to the Constitutional Court, all right? So the SCA held that the clients received loan cover free of charge, there was no consideration, and without consideration, the supply of loan cover did not qualify as an enterprise as envisaged in 7.1 of the VAT Act, and it was therefore not chargeable with tax. It was not a taxable supply in terms of Section 7.1A of the VAT Act. And 7.1A, of course, is our charging provision of the VAT Act. That is basically the sort of central provision that says that VAT must be charged on any supply of goods or services by a vendor in the course or furtherance of carrying on an enterprise. So if you don't have a taxable supply under Section 7.1A, then you would not be eligible for the deduction under Section 16.3C. Okay, and they also made the finding that the supply of the loan cover was an exempt supply, linked to the fact that these loans obviously generated interest, and interest was exempt. So there's no doubt that interest income that's an exempt supply, all right, interest, but bank fees is a taxable supply. So the question is, are we looking at something where a taxpayer is carrying on a business, and you look at the broader scale of the business, and then within that business, there might be something that is provided for no consideration, but it doesn't deviate from the bigger picture of this business that is carried on? Or do we look at the insurance cover on its own in a very isolated sense, and then say that insurance cover is definitely exclusively linked to the loan, which generates interest and which is an exempt supply? So you can see that it does get fairly complex. Now, well, clearly, the fact that it had to go all the way to the Constitutional Court before we actually got a final say on the outcome of this. Now, I do just want to pause and just change direction for a moment and talk about the penalty here before we go on to the Constitutional Court decision. What is interesting is that Capitec, when they put their VAT returns together for this particular tax period, they claimed this 71 million as a deduction against their output tax, and that meant effectively that they had underpaid the VAT compared to what SARS said that they owed. And so as far as SARS was concerned, they had made an underpayment, or a late payment, if you like, because they did eventually pay the Section 71 million rand, but under duress. They were still of the view that they were not liable for it, but they did make the payment, but obviously it was made late then. And so SARS charged a late payment penalty of 10%. And that's a penalty charged in terms of the Tax Administration Act, in terms of Chapter 15. It's not an understatement penalty. It's a Chapter 15 penalty, this 10% late payment penalty. So the penalty is charged actually under the VAT Act. It talks about if you make your payment late, you charge 10%. And in terms of Section 213 of the Tax Administration Act, it becomes a penalty within that provision. Then if we looked at getting the penalty waived, Section 217 of the VAT Act provides for remittance, and it says that if a penalty has been imposed, as had happened in this case, this 10% penalty, SARS may remit the penalty or a portion thereof if they are satisfied on all three of these requirements. And you may be fairly familiar with this if you've ever been applying for the remittance of a late payment penalty. Could be any kind of late payment penalty. It could be late payment of VAT, late payment of employees' tax, late payment of provisional tax. It really all comes down to the same thing. That if you're looking at a remittance of that penalty, you would have to satisfy SARS that all three of these requirements have been met. The first one is an either-or requirement. Either the penalty is imposed in respect of a first incidence of non-compliance, or it involved an amount of less than 2,000 Rand. Now, clearly, the 2,000 Rand is completely off the table here. But indeed, Capitec had a clean record with SARS, and this was the first penalty that had been incurred. When you talk about a first incidence of non-compliance, you're saying that there's no penalty charged over the last 3 years. And they certainly did meet that criteria. So they had a clean record. So that box was ticked. The next one is that there must be reasonable grounds for the non-compliance. And the third one is that the non-compliance must have been remedied. Now here, as I say, they did settle the 71 million under duress. Although they felt they weren't liable, they paid it, and they were hoping, obviously, to get a refund. So that issue had been covered. It had been remedied. But were there reasonable grounds for the non-compliance? And this issue about reasonable grounds is often quite subjective. How do you satisfy SARS that there are reasonable grounds for the non-compliance? The most basic interpretation of reasonable grounds is that there are circumstances beyond the control of the taxpayer. So, we had a major power failure that lasted for a week, and the banking system went down or something like that. So that would be reasonable grounds for non-compliance. But here you'll see in Capitec's case, so in the judgment, they went on to say it is the first time a penalty was charged. So they ticked that box. In terms of reasonable grounds, they said there were reasonable grounds for Capitec claiming the deduction. They had obtained a favorable opinion from senior counsel, and the only way they could reasonably test the issue was to actually go ahead and claim the deduction in the tax return. So they had met that requirement of reasonable grounds because they had this opinion. They were relying on the opinion, and obviously that opinion had to be tested, so they went ahead and claimed it. So there were reasonable grounds to end up with a late payment. So that's an interesting one in terms of seeing the application of that penalty provision. So at the SCA level, it was held that the late payment penalty must be waived. Okay, so that was taken out of the equation. And what was left was to look at the actual tax situation, the VAT deduction under Section 16(3)(c). So that's what went on to the Constitutional Court. And I must say, a very well-written, very well-reasoned judgment written by Rogers J. and assented to by all the other judges in the Constitutional Court, 11 of them. They'd distilled all of these complex questions down into a list of a logical progression of sort of 8 different questions. As we go along, you'll see they then come to the point where they say we're just going to conflate the rest of these into one issue. But initially, they teased this out into these different aspects. So start at the beginning, right? We've got this loan cover. Factual question, was it provided free of charge? And I mean, that's pretty easy to answer. Yes, it was. We can see that it was in the contract between Capitec and the client that it was provided free of charge. There was no consideration. If so, does this lead to the conclusion that the provision of the loan cover was not a taxable supply? So now we need to think carefully, because the question of whether it's a taxable supply or not, that's important. Just remember, going back to section 16.3c, the proviso says that in order to get that deduction, the supply of the contract of insurance has to be a taxable supply. All right. So if we make that supply of the contract of insurance for no consideration, is that a taxable supply or is it not a taxable supply? Then the third question, and we'll come to the answers on these ones just now. If the answers there lead to the conclusion that the provision of the loan cover could be a taxable supply, then the next question is, was it made in the course or furtherance of a purely exempt activity? Because if it is, then that's the end of the inquiry. We would have to say, well, it's a supply in the course of making it of an exempt activity, earning interest, that is all, and then there would be no deduction. But if it's not made exclusively for exempt activity, but it's made partly for taxable, partly for exempt, then you can see this is now starting to head towards possible apportionment. But before we even get there, there's another matter that the SCA raised and that SARS agreed with the SCA, and it was this, and it's rather a curious one. So they took the view that Capitec is charging bank fees to the clients, which is a taxable supply, right? And they're also charging interest, which is an exempt supply. But then they said, as that loan is outstanding, the bank fees get capitalized into the loan account and so effectively become part of an exempt supply itself. So the fact that the fees become capitalized basically turns them into being an exempt supply. Anyway, that one was dispensed with quite quickly by the Constitutional Court, and they said that was an error that was made by the SCA. They should not have reached that conclusion. It doesn't make sense. All right, but it is something, it's a question that they raised, they considered, and they dispensed with that one. They said if that answer is not dispositive against Capitec, so in other words, we're still on track to possibly get some or all of this deduction under section 16.3c, can Capitec get a deduction of the full amount, even though the loan cover was also provided for an exempt activity? So now looking at the fact that, hang on a minute, we have to recognize that, yes, we do have taxable supplies in terms of the bank fees, and that is not negated by the fact that those fees get capitalized into the loan account. But we also have the exempt supply in terms of the interest. All right. So then, you know, is it right that Capitec would get a full deduction under section 16.3c, or should we have an apportionment? And that goes into the next one. But then it leads to the question, and this is where the VAT Act gets complex, and one has to be very specific with the VAT Act. We can't just take a generalized statement and say, well, let's apportion. You're apportioning on the basis of what specific provision? So normally, you would apportion under section 17 of the VAT Act, which talks about when you pay VAT on your expenses or the acquisition of goods or services for the purpose of making mixed supplies, then you will apportion that VAT on some basis, usually on a standard turnover basis, which is in line with SARS Binding General Ruling 16, which we'll even come to a bit later when you look at VAT rulings. But section 17 is based on the principle that you have paid VAT on those expenses and the acquisition of those goods and services, and then you apportion that VAT. But with section 16.3c, and this is where we're saying it's not actually an input tax per se, because you haven't actually paid VAT. It's an imputed, it's like a notional calculation that you're doing, whereby you're saying, this is my indemnity payment that I'm paying out under this contract of insurance. I'm applying my tax fraction to that amount, and that's giving me a number that I'm then going to deduct from our output tax. So it's not that you've paid input tax and you got a tax invoice, you know, and then you're going to go and claim that as an input tax deduction. It's a different process. And so the question is, do we still apportion under section 17, or is there another basis for apportionment? And then they also looked at the relevance of the policies issued by the insurers, but that really was overshadowed by the other arguments that went along. So we've said that the loan cover indeed was provided free of charge, But does that mean that it is not a taxable supply? Now, this raises, again, getting into the technicalities of the VAT Act. What exactly is a taxable supply? So a taxable supply is a supply made by a vendor in the course of carrying on an enterprise, and that becomes a taxable supply under Section 7(1)(a). All right. But when you look at Section 7(1)(a), it does not itself require a consideration. So if you look at the wording of Section 7(1)(a), and maybe I should just give that to you quickly. So 7(1)(a) says that VAT must be levied on the supply by a vendor of goods or services in the course of or furtherance of an enterprise. That's it. So it doesn't say that there has to be consideration. Where does the requirement for consideration come in? It actually comes in the definition of enterprise. When you look at the definition of enterprise in Section 1, the definition of enterprise says, in the case of any vendor, an enterprise or activity which is carried on continuously or regularly by any person in the Republic or partly in the Republic, and in the course or furtherance of which goods or services are supplied to another person for consideration, whether or not for profit. So that's where the requirement for consideration comes in. In order to be carrying on an enterprise, which is the starting blocks for then registering as a vendor and then making taxable supplies. So to carry on an enterprise, you must have somebody carrying on this business in the Republic, in the course of which they are supplying goods or services for a consideration, whether or not for profit. So in this paragraph over here, they say, although the definition requires that it would be making a supply of goods or services for consideration, notice here, it does not require that all goods or services have to be supplied for a consideration. If you think about it, you may well have a business, which is, there's no doubt, let's take, I mean, even, you know, a business we all know, like Pick and Pay, Woolworths, whatever. They are in business. No one would doubt that they are carrying on an enterprise. And in the course of carrying on that enterprise, they are supplying goods or services for consideration. But from time to time, they might give away something for free. They might say, buy one, get one free, or they might give a discount, or they might say, if you present your Woolworths card, you'll get a free chocolate, or whatever the case might be. So there, when they are supplying something for no consideration, that doesn't mean that they are now not carrying on an enterprise, right? And even for that particular product that is supplied for no consideration, you're not going to isolate that and say, no, that's now outside of the enterprise. It's all part of the enterprise. We're carrying on an enterprise. We're supplying goods or services for consideration. And in the course of doing that, there's an element of making something available for no consideration, but it doesn't detract from the fact that we're still carrying on an enterprise. And when we are supplying goods or services to the customers, most of that is going to be taxable supplies when you actually have a consideration. Because in order to work out VAT under Section 7(1)(a), we're talking about a supply of goods or services in the course of carrying on an enterprise. And then we've got the value of supply rules in Section 10, which tell us the value of the supply. And then based on that, we would then charge the appropriate amount of VAT. Okay, so that's where you've got your consideration driving your output tax. But the short answer is that just because you are supplying something for no consideration within the framework of carrying on an enterprise, that does not mean that you're now suddenly not carrying on an enterprise or that somehow you are not making taxable supplies. So you'll see in this paragraph of the judgment over here, it follows that Capitec's supply of the loan cover was not disqualified from being a taxable supply merely because it was supplied free of charge. And the SCA erred in finding otherwise. So that supply of loan cover, coming back to that requirement of Section 16(3)(c), that the supply of the insurance contract must be a taxable supply, we're saying indeed it was a taxable supply, the supply of the insurance contract, all right? But then we have to say, was it supplied purely in the course of furtherance of an exempt activity? Because now you've got your loans earning interest and you've also got your bank service fee. is that supply of the insurance company only specifically related to the loan, or is it related to the overall business? And in the judgment, it stated that Capitec recognized that by providing the free loan cover, it was making its overall credit offering more attractive. Okay, so it was boosting the whole business, and that was boosting, in other words, it was done in order to earn both more interest and more fees. Interest being an exempt supply, fees being a taxable supply. So if we say, what is the purpose of providing this loan cover? It's actually to produce more interest and more fees. So it's actually for the overall business, but it's for both. So now it starts looking at the question of, hold on a minute, it's for both. It's not just for one. And that means it is producing both exempt and taxable supplies. Now, Capitec put up evidence and they said that was clear and undisputed. The free loan cover was provided because it made Capitec's loan offering to unsecured borrowers more attractive. So it was done as a kind of a marketing exercise to grow the overall business. But then it leads to the question of, then can you still deduct the whole amount under Section 16(3)(c), or do we have to do some sort of apportionment? And here the court in the judgment took the view, they said, well, now we look at all these other remaining issues together, and we must look at four possibilities. When you've got a supply of a contract of insurance, which is a mixed supply, it's made both to produce both taxable and exempt income, all right, and it's made simultaneously for exempt activity and an enterprise activity, then either, well, there's four alternatives, okay? Number one is that the vendor could deduct the whole, the tax fraction on the full amount of the payment, which is what Capitec wanted. They wanted the 582 million times the tax fraction of 14 over 114, giving the 71 million that they wanted to deduct. Or you take SAR's opinion of saying, no, there's no deduction at all. So that's the two polar opposites. Or you come in between and you say, well, no, there would have to be an apportionment. But then the question is, under what provision would you get the apportionment? And so the one possibility is that they claim the tax fraction invoking the Section 17 apportionment provisions. Or the other one is to say, we have an apportionment, but it's not under Section 17, it's actually under Section 16(3)(c). And the court came to the conclusion that indeed it would be an apportionment under Section 16(3)(c), because they said Section 17 can't apply, and I gave this away earlier, because they didn't actually pay VAT on goods or services consumed, used, or supplied in the course of making these mixed supplies. Remember, what they're claiming is this calculation of tax fraction applied to the amount paid out under these indemnity payments of 582 million. So you're not saying, here's my VAT, and that's what I'm claiming. You're actually working out this kind of notional input tax, if you like, on these indemnity payments. And so they said, implicit within that Section 16(3)(c) is an apportionment. Although it doesn't specifically state it in the provision, it would be implicit within the provision. And therefore, the conclusion was that it should be apportioned. So that 71 million we should apportion between Capitec's exempt and taxable supplies, and only claim the portion that relates to the taxable supplies. But now there's a tax administration problem, because Capitec never raised the question of apportionment in their plea to the tax court. All right, they didn't raise it in the objection, they didn't raise it in the appeal. And so when they objected against the whole of SAR's disallowance. They never asked for an apportionment. And the question was, can we grant apportionment if the taxpayer never asked for it? They failed to put that forward as an alternative objection. Now, the tax court rules provide that you cannot raise a new ground, okay, that constitutes a new ground of objection against part or amount of a disputed assessment that was not objected to under Rule 7. So you can't raise something new. But they said, look, Capitec here had objected to the whole of the disallowance of that Section 16(3)(c) deduction. So the fact that ideally they should have asked for apportionment, but the fact that they didn't ask for apportionment didn't necessarily mean that SARS could not grant them apportionment. So they basically said that SARS has the constitutional obligation to charge only the tax that is due, and that they should not have disallowed the whole objection. They should only have disallowed the part of the deduction that related to the exempt supplies. So the conclusion was we can now make the order that the tax court should have made, and obviously then through to the SCA, that the SCA should have made, that they should have referred the assessment back to SARS for further examination. On the face of it, the appropriate apportionment will be based on the proportion of the taxable fees to the total consideration. The evidence points to the likelihood that this could be determined accurately and with relative ease, and therefore they agreed they should remit the matter back to SARS. So the outcome of that was that the 71 million rand, if you take the split between taxable and exempt supplies, the exempt supplies, the interest income derived by Capitec makes up about 90% of their total income. Taxable supplies, it says in the judgment, are between 8 and 10%. So they would only have got, at the end of the day, that sort of between 8 and 10% of that deduction. Not 71 million, but maybe 7 million. So was Capitec successful in this case? Well, they were partly successful because they did successfully fight for this kind of 7 million rand input tax deduction. But what is interesting in this case is the very important principles that it puts forward in terms of the interpretation of the VAT Act around the issue of those fundamentals of what exactly is an enterprise, what is a taxable supply, and when you look at section 16.3c, is there apportionment available within that provision, or is it an all or nothing situation? And of course, the outcome was that there is an apportionment possibility within section 16.3c, and that is what was appropriate in Capitec's case. All right, so yeah, very interesting judgment, and coming from the Constitutional Court, very interesting outcome, and it's wonderful to get this degree of clarity on these aspects of the VAT legislation, which, as I said at the beginning, is extremely complex. Right, so remember, if you have any questions, pop them into the chat box and I'll pick them up as we go along. I'm not seeing any questions just yet, so I'll just carry on into the next case. And the next one is the EnviroServe waste management case. All right, EnviroServe versus SARS. This is a judgment actually handed down by the SCA in December last year, but it was published early this year, so we brought it in as part of this year's case judgments. It's an interesting one dealing with section 12C, which of course section 12C is our tax allowance, our incentive, our capital allowance for plant machinery used in a process of manufacture or similar process. Now, on this particular asset, EnviroServe wanted to claim the 12C allowance at 40% in year one, on the basis that it was new, unused, brought into use for the purposes trade in the process of carrying on a process similar to manufacture. SARS said, on the other hand, no, that is not the correct allowance. SARS said you should rather claim the section 37B allowance, and I'll show you the wording of the legislation just now. Section 37B goes under the heading of deductions in respect of environmental expenditure, and it does consider two different types of assets. One asset kind of very similar to what we look at under section 12C, and the other asset very similar to what we look at under the building allowances of section 13, where you're talking about a kind of permanent asset and you're looking at a 5% per annum allowance. SARS was really saying that EnviroServe should claim the 5% per annum allowance on the basis that this asset was similar to a building or a dam or something of that nature, and EnviroServe wanted the 40% allowance under section 12C. And when we look at the process of EnviroServe, which I'll show you on the next slide, that the asset under investigation was actually not plant machinery as we would often think in an industrial factory. but it was cells that were built into landfills and used for the treatment and storage of waste. The question was whether that qualified as plant. Now, the definition of plant, when you look at plant and machinery under section 12C, we've already had quite a lot of case law going back many, many years, whereby the definition of plant is quite broad. I mean, remember at one stage, we also even looked at a railway line. I think that was the Blue Circle cement case and so on. So plant has a very broad definition. So the question of whether these cells built into landfills qualified as plant, and the answer was yes, they do. But then the next question was, well, are these assets actually used in a process similar to manufacture? And that looks at the process that's going on within these cells that were built. And I'll come to that on the next slide. But I just want to also, before I get into the detail of section 12C, just look at the other aspect that came before the SCA, also an appeal from the tax court, was the understatement penalty. So EnviroServe had claimed the 12C allowance, 40%. SARS said, no, you should have only claimed 5%. So there was an understatement of taxable income as far as SARS was concerned, gave rise to a shortfall, and SARS on that basis applied the understatement penalty. They applied the understatement penalty. I'm getting distracted here. They applied the understatement penalty on an under-declaration of interest income from a subsidiary, on a loan to a subsidiary. Now, the interesting thing with this understatement penalty is that the court held that the understatement penalty should not have actually been charged because the because SARS had failed to show that there was prejudice. Now, when you look at the understatement penalty, and here we have to flip through to the Tax Administration Act, obviously, in Chapter 16, and we look at the understatement penalty in terms of Section 222, and it tells us that if there's an understatement as defined, which other than one that has arisen because of a bona fide inadvertent error, then SARS must levy the understatement penalty. When you look at the definition of an understatement, what exactly is an understatement? It says there's been, let's say, a failure to submit a return, an omission from a return, incorrect statement, which has caused prejudice to SARS. All right, so it's got to be those two together. So if there was an understatement because they failed to disclose interest income, it's not just the fact that you failed to disclose, it must be that it caused prejudice to SARS. Now, in this particular case, it was actually a loan that was proving to be irrecoverable in any event, and that interest income hadn't been disclosed by the taxpayer. But the onus on SARS under Section 102 of the Tax Administrations Act says that SARS bears the onus of proving the basis on which the understatement penalty is charged. And so if SARS did not prove that there was actual prejudice, and there was no prejudice here because this loan was never going to be recovered anyway, so the interest would be declared, then it would be written off, and in any event, EnviroServe had a massive assessed loss. So there was no actual prejudice to SARS. But the finding wasn't conclusive on whether there was prejudice or not. The point here is that SARS had failed to prove that there was prejudice. And on that basis, the understatement penalty fell away. So we left then with just looking at the question of Section 12C. So let's bring our minds back to this question of whether these cells were used to house a process similar to a process of manufacture. Now, I got this diagram. I think it's quite a nice one from Geosciences. I've given the reference over there, and it shows what this cell is. So when we talk about the asset on which EnviroServe wanted to claim this 40% allowance, this is the asset, is that it's this cell that they dig into the ground. So they dig down, and then they build the cell basically out of concrete, and then that cell, you then throw all of this rubbish in there, basically, and then that goes through this process of decomposition and biodegradation. What happens also is that rain falls onto this rubbish that's in the cell, and that process forms then this leachate offshoot. It's a kind of a byproduct that comes out of this process, although SARS regards it as a byproduct, but EnviroServe says that's exactly what they're working towards. They construct this whole system so that they can extract the leachate, and they then take that out and put it into a holding container, which prevents this leachate, which is extremely toxic, prevents that from leaking into the groundwater. Now, we all know the problems with water in South Africa, and I was just listening to a presentation last night about how serious our challenge is in South Africa in terms of ensuring that we have adequate and sustainable good water supply. And so all of these land treatment sites are designed on the basis that you don't just want this offshoot running down into the groundwater. So they create this in order to go through this process of degradation and biodegradation, decomposition, to extract the leachate and keep that in a secure container. And it's this cell that they are looking at in terms of the allowance. So which allowance should they get? And SARS said that they should get the 37B allowance. The taxpayer said, no, it's the Section 12C allowance. Now, the Section 12C allowance, as I say, they wanted the 40% in year one and then the 20% in the following 3 years on the basis of new and unused plant owned by the taxpayer, brought into use for the first time, used directly in a process similar to a process of manufacture. That was the taxpayer's argument. SARS was looking at Section 37B. Now, Section 37B was introduced into the Income Tax Act more recently, obviously, than Section 12C, and it was specifically introduced because of the fact that there are environmental assets that are used by taxpayers that don't qualify for the 12C allowance, and therefore this is an alternative that is granted to provide at least some relief for these assets. And when we look at the 37B allowance, we've got A and B, right? So A gives you something very similar to the 12C allowance, and it applies on the new and unused, again, similar to 12C. But the type of asset that they're looking at is environmental treatment and recycling asset. What does that mean? Well, it's defined in that provision to say it's air, water, solid waste treatment and recycling plant or pollution control and monitoring equipment, if that equipment or plant is utilized in the course of the taxpayer's trade. And now look at the wording here, in a process that is ancillary to a process of manufacture or similar process and required by law to protect the environment. But it talks about an ancillary process, all right? Whereas EnviroServe said this is actually a process similar to manufacture. It's not an ancillary process. But nonetheless, SARS wasn't even looking at that allowance. They were looking at this allowance, the 5% per annum, on, again, new and unused environmental waste disposal asset. And there, that's defined as air, water, and solid waste disposal site. And it could be a dam, dump, reservoir, or other structure of a similar nature, or any improvement thereto, if it's permanent, utilized in the course of the taxpayer's trade. And look here again, in a process that is ancillary to a process of manufacture and required by law to protect the environment. So EnviroServe was saying it's not 37B that is the correct provision here, because we are not talking about a process that is ancillary to a process similar to manufacture. We are looking at an actual process similar to manufacture, not an ancillary process. They said what's going on in this cell here is a process similar to manufacture. So that in order to evaluate this, the court had to look at all the old case law that you probably remember going back to your university days, looking at what constitutes a process of manufacture or similar process. And if you think back to things like the Saffron Mark case involving KFC, basically, the manufacture or the making, let's call it the making of KFC to start with. But the finding was that the final product that came out of that process was significantly different in terms of content, form, structure, chemical composition compared to the original raw material. And so there was a transition that happened between the raw material and the finished goods, which made it a process of manufacture. And then it was worked towards with plant and with human labor in order to arrive at that finished item. And so when we talk about a process of manufacture, we're looking at some effort, a designed process that is undertaken in order to turn raw materials into very different finished goods. Now, SARS said that this process that goes on in the cell over here, where it's producing this leachate, SARS was of the view that basically that leachate is not manufactured. You're not working towards that. They just said that is an unwanted byproduct. And it happens, it's just turns out when water enters the landfill, then you end up with leachate. And so SARS said that these cells are not used for the storage of waste or for a process similar to manufacture. They said they're more like buildings. They're not really plant. They're more like dams, reservoirs, etc., as we saw in section 37B2B. And so they said, no, it must be the 5% allowance, not the 12C. But EnviroServe, drawing on this case law around what constitutes a process of manufacture, basically said manufacture in the wider sense can be said to mean the making of any sort of article with physical labor or mechanical power. And even drawing on McNichol versus Finch way back from 1906, in which it was stated that the essence of making or manufacturing is that what is made is different from out of which it's made. In other words, your finished goods are very different from your raw material. And EnviroServe argued that the process that happens in that cell to generate the leachate through decomposition and biodegradation is a process that they are actually intentionally working towards. And it is a process of manufacture, that you're taking this refuse and you basically putting it through a process and you're extracting the leachate out of it. And that is a process of manufacture. And so the court came to the conclusion that the decomposition, biodegradation, and extraction of the hazardous leachate is an indispensable part of the treatment of hazardous solid waste. And the fact that the cells in which that leachate generation occurs are also used to permanently store the non-hazardous material does not detract from their use directly in the process of manufacture or a process similar thereto. The conversion of the collected hazardous solid waste into waste that is safe for storage is the purpose of the business. And this so-called unwanted, that's what SARS said, it's unwanted leachate. They said, no, in EnviroServe's case, it's actually an intended or desired product. So it might not be nice, it's toxic, we have to put it into permanent storage, but it's what we undertake this project for, is to extract that. It's very intended, it's exactly what we want, and it's the process that we've undertaken to do that. And that process is a process similar to a process of manufacture. And on that basis, the cost of the cells qualified for the 40% write-off under Section 12C. So just a very interesting case, and I think especially looking back at this process of manufacture, we haven't seen this question for a while around what constitutes a process of manufacture, and this whole question of what constitutes plant and machinery. And then, of course, looking at that in the context of our landfill sites and the process that goes on there, I think, yeah, it's just very interesting in terms of our current environmental focus. Okay, so moving on from there to the next one, a very different case of Unitrans Holdings versus SARS. And this is a Johannesburg High Court case, judgment handed down in January this year. And Unitrans Holdings is a holding company with a number of subsidiaries, and they provide a sort of treasury function, if you like. So they obtain funding from the banks and they make that funding available to their subsidiaries. If there's excess money in the subsidiaries, it comes back into this centralized treasury function on a pretty much a day-by-day basis. So everything is kind of closed out at the end of every day, and some subsidiaries might require funding from the holding company. Other subsidiaries might have excess funding that they lend back to the holding company. But obviously here, when we're looking at interest expenditure, so it's where there have been borrowings that Unitrans Holdings has taken out borrowings. They've paid interest on these borrowings. And of course, when you look at the deduction of the interest, you have to look at the purpose. What is the purpose of that interest, and that comes back to the purpose of the loan borrowing itself. Why did you borrow this money? So we borrowed the money in order to make it available to the subsidiaries, but then what was the real purpose there? Was it for the purpose of the trade of Unitrans and in the production of income of Unitrans, or was it really for the benefit of the subsidiaries and for the purpose of the trade carried on by these subsidiaries? And it was held that the interest expenditure was not really closely linked to Unitrans's income earning operations, but it was really to further the interest of these subsidiaries. And therefore, the interest expenditure was not incurred in the production of income of Unitrans holdings, and therefore they should not get the deduction. Now, I'll go into this in a little bit more detail in a moment, but again, I just want to point out to you that another aspect of this case was, again, the understatement penalty. So Unitrans had claimed the interest deduction under Section 24J2. SARS said they were not entitled to the deduction, and so there was an understatement of taxable income, which gave rise to a shortfall. And going back to what I read you earlier in terms of Section 222 of the Tax Administration Act, whenever there's an understatement which involves prejudice to SARS, SARS would charge the understatement penalty. But here, the question was whether the understatement penalty was due to a bona fide inadvertent error. And the taxpayer was trying to argue that it was due to a bona fide inadvertent error. But unfortunately, they didn't provide enough evidence to prove this. And so they were not successful as far as that was concerned. So the understatement penalty remained in this case. Now, it's interesting to see that because we've seen a number of judgments recently where at the court level, the understatement penalty has been remitted on the basis that, yes, there was an understatement, yes, it caused prejudice to SARS, but it was due to a bona fide inadvertent error, and therefore there was no grounds for the understatement penalty. All right, and this whole question of bona fide inadvertent error, you'll see it coming up again in a later case where the taxpayer was actually successful. That in many cases, we see that the taxpayer has relied on an opinion from a tax expert. In a later case, we'll see they relied on a document from SARS, and on that basis, they operated in good faith, which meant that although they ended up with an understatement, it was a bona fide inadvertent error, and therefore the understatement penalty should not be charged. So it's an important one to look at because there's not many grounds for the remittance of an understatement penalty. But certainly on the basis of a bona fide inadvertent error, it's something that one should perhaps look at. Now, if you read the SARS guide on understatement penalties, you'll see that they take an extremely narrow view on what constitutes a bona fide inadvertent error. They basically say it's only where there has been a capturing error. But the courts have taken a much broader view. And this aspect of taxpayers relying on an opinion, relying on a document from SARS and so on, which meant that the taxpayer was operating in good faith, was sufficient to generate this finding of a bona fide inadvertent error, and therefore the penalty was waived. So did Unitrans charge interest on the loan to the subsidiaries? Yes, it did, Peter. And that is, so what happens then is that even though they couldn't claim the deduction necessarily on the basis of it wasn't in the production of their income in the course of carrying on a trade, but they were looking for the full deduction, but they could get a partial deduction because they could deduct up to the amount of the interest income on the basis of Practice Note 31, and you'll see that coming through. Let me not get too far ahead of myself here. But let's just get to this principle of the tax deductibility of interest. So we know that interest we deduct under Section 24J, and that allows us to deduct income, deduct interest from the income of the taxpayer, where that income is derived from the carrying on of a trade. So we see the trade requirement, and the interest must be incurred in the production of income. So there's no distinction between capital revenue, but you've got these two requirements, the trade requirement and the production of income requirement. Okay. And pretty much Section 24J applies to most interest. And it also, of course, has the interest income aspect to it and the interest deduction aspect. So we're looking at the deduction of interest here. But we've got this holding company with the subsidiaries. And so here we have to say, is the interest incurred in the production of income, and is it incurred in the course of carrying on a trade? So let's look at the production of income. There you've got to look at the purpose of the expenditure, and there the interest expenditure arises from a loan. So what was the purpose of raising the loan? And what did the interest expenditure actually produce? So here the interest expenditure produced interest income from the loans advanced to the subsidiaries. And was there a close connection between expenditure and the income earning operations of the taxpayer? That's some of the principles that came through the Nemegem case and the PE electric tramway case. So the production of income, let's just keep that at one side for now, but let's look at the trade requirement. Have we incurred this interest expenditure in the course of carrying on a trade? Now, the case law principles here, of course, we've got a definition of trade in Section 1. We've been told, for example, from the Burgess case, that that definition must be given a wide interpretation. And so, yes, it's a wide interpretation, but it's not completely exhaustive. It is a situation where if you have somebody who is simply watching over investments, that is not a trade. So to be a trade, there must be something more. For example, a share dealer or somebody who is entering into a venture, they are risking something in order to get some sort of reward. But just watching over investments is not a trade. And that's why we get investors versus, let's say, share dealers. And we know that when you've got someone who is a pure investor, they don't meet the trade requirement for the deduction of interest. But then that's where Practice Note 31 has come to the assistance of those taxpayers, and that then allows the deduction of interest. Although you're not carrying on a trade, you can deduct the interest up to the amount of the interest income. All right. But just carrying on with the trade requirement, just to finish that off, the test as to whether a taxpayer carries on a trade is a factual inquiry, and no single set of rules can be laid down in this regard. So Practice Note 31 enables SARS to, in practice, allow the deduction. And Practice Note 31 actually is fairly broad. It talks about the deduction of expenditure incurred in the production of interest income where the taxpayer is not carrying on a trade. Then we would use Practice Note 31. Although Practice Note 31 is not binding, the practice of SARS is to allow the deduction even where the trade requirement has not been met. Now, we know that in last year's legislation, which was promulgated in December last year, in our Taxation Laws Amendment Act of 2023, we saw the introduction of Section 11G. And that is because SARS announced in 2022, November 2022, that they were going to withdraw Practice Note 31 and Practice Note 37, but we've seen the focus so far only on Practice Note 31. That they're going to withdraw this practice note and replace it with a legislative amendment. And that's what's come through Section 11G. Now, Practice Note 31, as I mentioned earlier, that gives the concession to taxpayers who are not carrying on a trade. They incur interest as an investor. They're not carrying on a trade, but they would still be allowed to claim the interest deduction on the basis of Practice Note 31, but then only up to the amount of their taxable interest income. So they can't create a loss in that situation. Now, Section 11G that has now come through, remember, just to go back here, Practice Note 31 spoke to expenditure, all right, and expenditure in a broader sense. But Section 11G only talks about interest. So it allows a deduction of interest in expenditure against interest income, but that interest expenditure is only allowed as a deduction up to the amount of the interest income. That's what it says over there. And this deduction is permitted where you've got interest expenditure incurred in the production of interest that is included in the income of that person. So it's not exempt, all right? and that person is not carrying on a trade. And it can be any person. They did amend this, thank goodness, compared to the draft bill that came out last year. So 11G applies to business companies, trusts, and individuals. And it's talking about a person who incurs interest expenditure. They're not carrying on a trade. They can then claim the interest expenditure against their interest income only up to the amount of the interest income. In other words, what is not exempt. So if you have interest income of 100,000 Rand and 34,500 is exempt in terms of your local interest exemption for individuals, so then you're only left with, what's that, 65,500. And if you've incurred 100,000 Rand interest expenditure, you can only deduct up to that 65,500. You can't create a loss in that situation. Now, the important thing is that Section 11G, first of all, only applies to interest expenditure, not any other expenditure incurred when you're not carrying on a trade. And it only comes into operation from the 1st of January 2025 and applies in respective years of assessment commencing on or after that date. So in the meantime, Practice Note 31 remains in place. So for now, we've still got Practice Note 31 for years of assessment commencing 2025 and onwards. Then we will have Section 11G coming into play. Okay, so in the case of Unitrans, to get back to the outcome there, Unitrans was trying to argue basically on the back of the Tiger Oats case, which was also a holding company, which also incurred interest on loans made to subsidiaries. And the question there was that Tiger Oats was integrally involved in the management of the subsidiaries. So they were actually carrying on a trade in that sense, that they were more actively involved. Whereas Unitrans didn't meet those same criteria. They were regarded as just watching over investments, and whatever expenditure they incurred in terms of interest was not incurred for their trade. It was actually earned for the benefit of the subsidiaries and for the subsidiaries trade. So the best Unitrans could get was a deduction making use of Practice Note 31, but not the full deduction that they were seeking. So, Peter, yeah, the other expenses like accounting fees, like a trust that earns interest income and has some interest expense, and this is exactly the concern with Section 11G. You see, Practice Note 31 very clearly spoke about expenditure incurred in the production of interest income where the taxpayer is not carrying on a trade, and it allowed the deduction of that expenditure up to the amount of the interest income. But now 11G very clearly only talks about interest expenditure. It says they'll be allowed as a deduction from the income of that person, interest incurred by that person. All right, so it's only allowing the interest deduction. So these other amounts at the moment are not catered for, unless they make some sort of amendment to Section 11G between now and when it comes into effect for years commencing from 2025 onwards. So currently under Practice Note 31, there is the possibility of deducting these other expenses. So any expenses incurred in producing that interest income, even though you're not carrying on a trade, but under 11G, it's only the interest expenditure that you'd be able to deduct. So it is concerning that the scope of 11G is actually much narrower than what we see in Practice Note 31. Okay, how are we doing time-wise? Still a couple of minutes before our leg stretch, so let's go on to the next tax case, which is the case of Walter. All right, so in the case of Walter, again, we are in the realm of income tax, but here we are looking at the gross income definition, and we're looking at what amounts come into the gross income, in this case of an individual, Mr. Walter. Now, Mr. Walter had established a business with a business partner, and it turned out to be very successful, although it did also attract the attention of SARS, and we've got other cases that deal with that actual business entity. But along the way, Walter and his business partner had a fallout, and they parted ways. And Walter, although he was a director of the company and he was an employee of the company, but he left that company And some 4.5 years later, after his employment had ended, after he had walked away from the company, there was this restraint of trade payment. Because even after he had left as an employee and he had resigned as a director, his family trust still retained his shares in this company. And so it's only 4.5 years later, it was decided that actually they wanted to sever ties altogether. And so it was agreed that the company would enter into a share buyback and actually buy those shares back from the family trust. So there was a payment that went from the company to the trust to buy back those shares. That was not the subject of this case. This case dealt with an additional payment that was made by the company directly to Walter, and that was made as a restraint of trade payment. But this restraint of trade payment was made 4.5 years later, after Walter had actually ended his employment. So it wasn't made to an employee. It was made to somebody who had previously been an employee and or office holder of this company. And the question was whether this restraint of trade payment should have been included in Mr. Walter's gross income. There's a special inclusion under paragraph CB of the gross income definition, and we'll have a look at that just now. And the question was whether this restraint of trade payment came into that special inclusion. And that would mean, was there a sufficient causal link? Was there a causal link between the restraint of trade payment and the person's past employment with the company? So that was the question, whether this restraint of trade payment came into his gross income. Now, you'll see that this was an appeal that Walter, again, the taxpayer, took to the High Court against the finding of the tax court. And the judgment of the tax court, I've given you a link there to the judgment, that was handed down in 2022, and it gives a lot of background detail on the facts of this case. And what we see coming through both of these judgments is that when Mr. Walter received this 60 million rand restraint of trade payment, he got hold of somebody at SARS and asked them what was the nature of this. Should he bring this into his gross income? Should he pay tax on this amount? And he had some kind of correspondence from SARS, which he called a directive or a ruling. He took it as a directive from SARS, telling him that this 60 million rand was capital in nature and did not have to come into gross income, but it should be treated as a capital gain. And so he included, in those days, of course, individuals, currently you would include, 40%, in those days, I think it was 25% at the time of this actual year of assessment. So he only included that portion in his taxable income. He treated it as an amount of a capital nature, and he only brought some of it into his taxable income as a taxable capital gain on the basis of this supposed directive that he had received from SARS. Now, the inherent nature of a restraint of trade payment would be capital. It is capital in nature because you are paying somebody to restrain their ability to earn income. That's the very nature of it. You're saying you cannot enter into another employment contract with this certain geographical area and over a certain period of time. So the inherent nature of it is that it is capital. But that's the whole purpose of a special inclusion in the gross income definition, is that it is specifically saying, well, this amount may well be capital, but we are specifically including it in gross income. And so when we look at this special inclusion under paragraph CB, if it actually falls within that special inclusion, then even though it is capital, it has to come into gross income. Now, what was interesting is that, again, he had treated this as a taxable capital gain, not as full gross income. So he ended up, in SARS' opinion, understating his taxable income. SARS levied an understatement penalty. And the taxpayer argued that, yes, although there was an understatement which resulted, it did cause prejudice to SARS, it resulted in a shortfall, but it was due to a bona fide inadvertent error because he had relied on this so-called directive from SARS. But now it was interesting because this, I keep saying it's a so-called directive. the finding was that this document from SARS was really quite intriguing because it wasn't a formal directive, and the individual who issued this document actually testified in the tax court to say that he was not a capital gains tax expert, and he actually, in his position, he never was empowered to issue rulings to taxpayers. He was involved more in tax collections, not in giving out rulings. So it's very curious, and it's never quite revealed as to exactly how the directive came about. But the court did say, well, Walter relied on that, and he thought it was a SARS directive, and therefore he did get the entitlement to have the understatement penalty waived on the basis that it arose from a bona fide inadvertent error. We'll see the detail of that just now. But coming back to the restraint of trade payment. So this special inclusion in gross income, paragraph CB, we've actually got two. We've got paragraph CA, which talks to labor brokers, personal service providers who receive a restraint of trade payment. And then we've got paragraph CB, which talks about a restraint of trade payment received by a natural person. And here, the restraint of trade payment received by a natural person would have to come into gross income if it was received as consideration for a restraint of trade imposed on that person in respect of or by virtue of employment or the holding of any office, or past or future employment or the holding of any office. All right, so if there's a link between, and remember we spoke about, is there sufficient causal link? Is the reason for this restraint payment the person's past, present, or future employment or the holding of any office? Now, Walter had certain know-how that he had built up while he was employed by this company. And so I think it's a pretty straightforward conclusion to reach here, that it is a restraint of payment, it is made to a natural person, and it is linked to past employment. That's why he was paid this amount, is because of his past employment. Maybe you could say, well, hold on a minute, there was a share buyback that was done here between the trust and the company. The company was buying back shares from the trust, the family trust. But this restraint of trade payment was made directly to Mr. Walter. But was this payment made to secure the value of the shares? So if we said by virtue of what was this payment made? Was it by virtue of his employment, or was it by virtue of the value of the shares? So Walter was looking at the share valuation argument, but the court came to the conclusion that actually it fell very squarely into the special inclusion because there was a causal nexus. The payment was made by virtue of his past employment and the holding of an office. He was director of this company, albeit 4.5 years prior to when this payment was made. But it was still by virtue of employment or the holding of office, or the past employment or holding of office, and therefore the amount came into his gross income. And so then it fell on the understatement penalty, right? He had understated his taxable income because he had treated this amount as a capital gain. And so what about the understatement penalty? And the court said, despite the dubious authenticity of this so-called directive, or whatever it was from SARS, the taxpayer relied on it. The taxpayer, Mr. Walter, saw it as a directive. And so the understatement, and this is a quote from the judgment, came about for an acceptable reason. That is, reliance was placed on a document which at least purported to be a tax directive, whilst in truth it was not. In my view, said the judge, if a taxpayer received such directive, he or she, or even a tax practitioner, will be acting bona fide to declare income on the basis of the directive, unless such a finding was clearly unsustainable. And so the finding was that he had relied on the directive, and there was no reason to consider that he should not have done so. And on that basis, it was held that the understatement was due to a bona fide inadvertent error, and therefore the penalty was remitted. So although he was unsuccessful as far as the treatment of the restraint of trade payment was concerned, yes, it had to come into gross income and not as a taxable capital gain, but at least he did get the remittance of the understatement penalty. So again, highlighting how important it is to look at these understatement penalties and consider whether one has placed reliance on some kind of directive or tax opinion that has been provided to the taxpayer, and that they were justified on relying on that in taking a certain stance in terms of the tax treatment, be it an expense or income. Okay, so that probably is a good time to take a break. It is just after 2:30. So let's take a break until 14:50. So that gives you just a 17-minute break, and then we'll carry on. So Danny, if you could just put a notice there that we'll carry on at 14:50 at 10 to 3. Okay, thanks very much, everyone. See you just now. right, it is 10 to 3. So shall we carry on? Okay, so let's have a look at ABD Limited. And this, as I said at the beginning, is a tax court case, judgment handed down in February. But the significance of this case is that it is dealing with a transfer pricing dispute between SARS and the taxpayer, which is a South African telecommunications company with subsidiaries worldwide. So you can use your imagination as to which company that would be. So ABD was the holding company, right? ABD Limited. And it had these various subsidiaries all over the world. And if you look at just a table that they've got in the judgment here, they had subsidiaries in Afghanistan, Benin, Cameroon, Congo, all over the place. And they licensed, ABD Limited licensed its intellectual property to the various operating companies. So it was a royalty payment, essentially, that was paid from the group operating companies to ABD Limited in South Africa. So ABD Limited is deriving this income. It's intergroup income, effectively, from these group operating companies. And the question is whether SARS was correct in raising a transfer pricing adjustment. So SARS had done, obviously, an audit on the taxpayer, and they had relied on the expertise of a valuations and a transfer pricing expert. On that basis, they raised an additional assessment, which the taxpayer objected against. SARS then brought in another expert who also came up with his own independent determination of an arm's length price. And his view resulted in an even greater transfer pricing adjustment. Now, of course, the taxpayer also had their transfer pricing experts and their valuation experts. They, in fact, had 3 of them. So you can see that this matter of establishing an arm's length price is really far from a simple matter. And it demonstrates just how complex the whole transfer pricing environment can be, and how it's virtually impossible for 2 people to agree on what a real arm's length price would be in the absence of a true arm's length transaction, because by its very nature, you have got this kind of closed environment. Now, let's just take a step back and have a look at transfer pricing and how this transfer pricing adjustment would arise. So transfer pricing arises, and perhaps I should just go to my little diagram on the next slide, and then I'll come back to this. But essentially, it's where you've got a cross-border situation, and you've got parties to a transaction in 2 or multiple different countries. They are transacting between themselves, and there is a flow of income from one to the other. Now, of course, the issue with transfer pricing is that you've got connected persons or associated enterprises. So you have this controlled transaction where it is possible to manipulate the price. This is not just somebody going out into the open market and buying an item of stock that happens to be on the open market and you just pay whatever the advertised price is. This is where there is a controlled transaction. And so the question then is whether an appropriate price has been charged. Now, the reason why transfer pricing is something that has gained the attention of the tax authorities all around the world is the feeling that if you had a group situation and you had different companies with different tax rates and you wanted to minimize your overall tax liability for the group in order to maximize your after-tax returns for the shareholders, you would tend to, if you could, minimize your income in a high tax jurisdiction and maximize your income in low tax jurisdictions, all right, or even no tax jurisdictions. And so the idea of transfer pricing is that you have these controlled transactions where the price of goods or services could be manipulated in order to shift profits into your or income into your lower tax jurisdictions. So you might do that by creating higher expenses or lower income in your high tax jurisdiction, or you might, because that would then result in rather shifting your profits over to the low tax jurisdiction to reduce your overall tax liability for the group. So if you could just bear with me, you're asking how transfer pricing would apply if the holding company was in America and charged the SA subsidiary a management fee. Well, I mean, you could, and maybe your answer will emerge also as we discuss some of the ABD case. But if, for example, you had this doesn't matter whether it's America or whatever other country, but if you had a holding company charging a subsidiary a management fee, the question is whether you fit within the framework of Section 31, whether you fit within the scope of Section 31. And if you do, then your transfer pricing adjustments would be made. So in terms of saying how would it work, I think bear with me while I go through and talk about how Section 31 actually applies. So Section 31 is our anti-avoidance provision in the Income Tax Act that caters for transfer pricing adjustments. But Section 31 has actually been around for decades, way preceding the OECD's BEPS project. The OECD's Base Erosion and Profit Shifting project was launched about 10 years ago, and that has brought tax jurisdictions around the world, around the table, to come up with a common framework that would address this whole question of base erosion and profit shifting, the idea of shifting profits to lower tax jurisdictions so that your overall tax bill of the group basically is reduced. Now, they've come up with these two pillars. You might be aware of it. We saw the second pillar being addressed in the budget speech this year and with legislation around the global minimum tax. And so there's different ways in which they have addressed this base erosion and profit shifting. In pillar one, they were looking at digital transactions and where those would be taxed. So there's different aspects to this, but they have a number of different sort of categories, if you could say, of areas that they are focusing on in order to address base erosion and profit shifting. And one of those is transfer pricing. So Section 31 did not flow from this project. We've had Section 31 way before this project was initiated, but it does fit very much in terms of the objectives of this base erosion and profit shifting project, as far as that one particular focus area is concerned, which deals with transfer pricing. Now, we have had some guidance from SARS along the way. We've got in SARS interpretation note number 127 that specifically deals with intra-group loans. And so intra-group loans, again, if you picture this scenario of being, cross-border, intra-group, they would fit in within connected persons and or associated enterprises. We've got loans that are advanced between these companies. I mean, this could be multiple companies, could be holding company, etc. But the idea is that your interest rate is not reflective of an arm's length interest rate, and or that the amount of the debt is also not reflective of the amount of debt that would be raised in an arm's length situation. So you can have transfer pricing applying when there are loans as well. It's what we used to call the thin capitalization rules, but now it just comes within the actual transfer pricing provisions. But this interpretation note deals with intragroup loans as far as that's concerned. Then we also, because of a later addition to Section 31, talking about who is affected, and we used to talk about the connected persons, and now they've added in associated enterprises. And so there was some confusion as to what we meant by associated enterprises. You'll see I talk a bit about this definition just now, but SARS has also issued an interpretation note number 128, which explains the meaning of that term, associated enterprises. But you'll see, I'll talk about that as we go through Section 31 and explain how Section 31 and when Section 31 actually applies. So, so we're talking about this cross-border situation, but in essence, we have to establish whether Section 31 applies, all right? It doesn't apply to all cross-border transactions. It applies where there is something called an affected transaction, and that is a term that is defined in Section 31. So in Section 31.1, we've got a series of definitions. Affected transactions, the first one, also because it starts with A, right? Okay. Then they've got a definition of associated enterprise. They've got a definition of financial assistance and a definition of connected person. But in essence, let me just put the point forward here. that connected person in most cases, and especially in the context we're talking about here, we would look at the Section 1 definition of connected person, which looks, companies within the same group of companies, and if it's somebody other than a company holding shares, you're talking about at least 20% shareholding. Remember that with a closed corporation, any member of a closed corporation is a connected person in relation to that closed corporation. So I'm not going to go into the whole definition of connected person, but that is obviously something that is important in terms of saying that could potentially bring you within the scope of an affected transaction. Okay. But I'm getting ahead of myself. So we start off by saying where there is an affected transaction as defined, and I'll look at that on the next slide. And there's also then, once you've established there's an affected transaction, there's another criteria that has to be met, and that is that affected transaction results in a tax benefit being derived by any person who is a party to the transaction. Okay, and when you talk about a tax benefit being derived, obviously it can be, for example, if you are charging too much for trading stock, for argument's sake, so that you're getting a greater deduction. Let's say here in South Africa, you're getting a greater deduction than you otherwise get for the purchase of that trading stock. That means you're getting a tax benefit because your greater deduction is resulting in less taxable income, which is resulting in less tax liability. So that's the type of tax benefit that we are talking about there. But let's have a look at this definition of affected transaction. What is an affected transaction in terms of the definition? So it talks about a transaction, operation, scheme, agreement, or understanding. So similar to what we see with our normal anti-avoidance provisions, we'll just call that a transaction. Entered into, between, or for the benefit. Now, remember, the wording here is designed to kind of make the scope as broad as possible. But let's get to the essence of what they're talking about here. A transaction between two people, we can call these the specified persons. Either one is a resident and the other one's a non-resident, a kind of classic cross-border situation, resident, non-resident. But it can also be between two non-residents if one of them has a permanent establishment in South Africa to which the transaction relates. Or it can be between two residents if one of them has a permanent establishment outside South Africa to which the transaction relates. So it's also creating that cross-border aspect. And it also applies where you have a non-resident and a CFC. Now, a CFC, a controlled foreign company, by definition is also a non-resident. It's a foreign company, all right? But of course, a CFC has certain tax treatment in terms of Section 9D, which talks about imputing the net income of that controlled foreign company into the taxable income of the South African shareholders. But that would only apply where you have a CFC as defined and none of the exclusions kicks in. All right, but the issue here is that although a CFC is also a non-resident, it's kind of a high risk, shall we put it that, entity. And so there, for South African tax purposes as well, I should mention that we kind of treat it as a resident. We talk about the net income of the CFC. You work out the taxable income as if that CFC was a resident. Okay, so you got a transaction between non-resident and CFC that can also come into the scope of an affected transaction. So there's four categories of your resident persons, but essentially what you're getting at is this cross-border element. Resident, non-resident, or two non-residents, one of them with a PE in South Africa, to which the transaction relates, and so on. So it's a cross-border element, okay? So it's a transaction, cross-border. Those persons to the transaction are either connected persons, essentially as defined in Section 1, or associated enterprises. Again, they've brought in associated enterprises to make the scope as broad as possible. And I'll come to the definition of associated enterprises on the next slide. So we've got these requirements: transaction, cross-border, the sort of controlled aspect, and any term or condition of the transaction is different. Any term or condition of the transaction is different from any term or condition that would have existed had those persons been independent persons dealing at arm's length. I mean, if you look at this between an individual and an offshore trust, Okay, and we often think about situations where that individual might advance a loan, maybe an interest-free loan to the offshore trust. So that there you've got a resident and a non-resident. You've got a transaction advancing the loan to the non-resident offshore trust. They would be connected persons, probably because in all likelihood, the person lending the money to the offshore trust is maybe the founder of the children who are, and the father of the children who are beneficiaries of that trust. Now, any beneficiary of a trust is a connected person to the trust, and any relative of those beneficiaries becomes a connected person to the beneficiaries and then to the trust. So there you would have a connected person situation. And then if it was an interest-free loan, well, there you have terms and conditions that are different from what would have happened if the trust had borrowed that money from a bank. All right, so that's one possible scenario where you see this definition of affected transaction working through. If you establish that there is an affected transaction, then the next step is to say, has that given rise to a tax benefit for one or other of the parties to the transaction? But let's just have a look at this definition of associated enterprise. So an associated enterprise means an associated enterprise is contemplated in Article 9 of the Model Tax Convention of the OECD Model Tax Convention. Most of our double tax agreements are modeled on the OECD Model Tax Convention. And we draw a lot of our guidance around our tax legislation and tax policy from the OECD. Although we're not a full member country of the OECD, we certainly have observer status, and we've participated heavily in this whole BEPS project of the OECD. Okay, so it's not a surprise that we would draw some of the OECD legislation, if I can put it that way, into our own. In fact, global minimum tax that has come into effect this year, that legislation is virtually entirely drawn from the model that has been set up by the OECD. So we do draw a lot from the OECD, especially as far as international tax is concerned. Okay, but if we say it's as per Article 9, so what does Article 9 of the Model Tax Convention say? It says where an enterprise of one country participates directly or indirectly in the management, control, or capital of an enterprise of another country, or the same persons participate directly or indirectly in the management, control, or capital of an enterprise of a country and an enterprise of another country. So you can see that it's more than just the connected person definition, because the connected person definition typically looks at shareholding, all right, which is one aspect here. It talks about control, but connected person definition doesn't necessarily require control. It just depends on who's holding the shares in what kind of entity. But here, it's not just shareholding. It goes into management, control, or capital. So even funding, if you are a major funder of an enterprise in another country, that could cause those two to be associated enterprises. So it means there's a big interlinkage between the two enterprises or between persons and an enterprise. If you have pretty much the same people who are all in the board of directors of 3 different companies, even though those 3 different companies don't have an interlinking shareholding necessarily, but the participation in the management could make those associated enterprises. Okay, so this is something that is quite new in our legislation. As you can see, it only came in from January 2023, and it is still something that many people are getting their minds around as to exactly what is an associated enterprise. If you want to explore that in more detail, then I suggest have a look at SARS Interpretation Note number 128, where they do go into that in a lot more detail, give various examples and so on. Okay, but let's come back to the ABD situation. So SARS applied Section 31. Now, in order for Section 31 to apply, you would have to meet all of these requirements of the affected transaction, all of these aspects, and then also the tax benefit. So there's 5 prerequisites: the transaction, the cross-border, either connected persons or associated enterprise, a non-arm's length aspect, and then there must be a tax benefit that is derived from that affected transaction. So in the case of ABD, South African holding company, operating companies internationally, and the South African company is making intellectual property available to the operating companies for which they are charging a royalty. So you've definitely got transaction, you've got cross-border, they're connected persons or associated enterprises, all right, definitely falls within that because they're all group companies, right? Operating companies within the group. And then you've got this, well, the question is, have you got non-arm's length terms or conditions? And the question is, has it given rise to a tax benefit? So there you'd really be saying, is the pricing of this royalty an arm's length price? It's like the example I gave of the loan going to the offshore trust. I said it's an interest-free loan. Well, that's clearly not a normal arm's length transaction. But if you were charging interest, should you charge interest at an arm's length rate, then there's no grayness around that kind of transaction. That would not be a non-arm's length situation, and it wouldn't give rise to a tax benefit. So in the ABD case, where they were charging royalties to the operating companies, it came back to this question of whether the royalties were charged at an arm's length rate. Now, if it transpires that all of those requirements are met and SARS applies the transfer pricing adjustment, just to finish off that side of the discussion, what they would do is they would say, what is the difference in value? So let's say that you said an arm's length charge would have been 100 million rand, all right? But you, ABD Limited, have only charged 10 million rand. So you've charged less than what the arm's length value would have been because we are in a high tax jurisdiction, 27%. So SARS would then say the difference in value, the 90 million, they would add on to the taxable income. That's your primary adjustment. So it's going to give rise to additional taxable income there. And also a secondary adjustment. In the case of a company, there would be a deemed dividend in specie. So that same amount of the 90 million that's added back to taxable income is also treated as a dividend in specie, which gives rise to dividends tax for the South African company at the rate of 20%. And you can't reduce that through a double tax agreement. So it's a 20% dividends tax and the 27% normal tax on that transfer pricing adjustment. If it was a transfer pricing adjustment affecting an individual or a trust, going back to my other example of the South African person advancing a loan to an offshore family trust. So there, again, you have not charged interest. An arm's length situation would involve interest. Has that caused a tax benefit? Yes, because less interest income, less tax payable. And so there SARS could do the adjustment, adding on to the taxable income. And because it's not a company here, it's an individual, that person would be deemed to have made a donation to that other person, to the non-resident trust. So the resident deemed to make a donation to the non-resident trust, which would then carry donations tax, right? So the dividend carries a 20% dividends tax, the donations tax, either 20 or 25, depending on the cumulative value of donations made by that person to date. Okay, so these amounts of the deemed dividend or the deemed donation, let's say that you've got a year-end end of February. In that February, let's say it was February 2024, SARS does the transfer pricing adjustment into the taxable income for that year-end, and then the company is deemed to have paid a dividend equal to that same 90 million rand in my example, and that would be deemed to be paid 6 months after year-end, so the end of August, and that means 20% donations tax has to be paid by SARS to SARS by the end of September. Okay, and similarly with the donations tax, donation deemed to be made 6 months after year-end, donations tax payable by the end of the following month to SARS. So the transfer pricing adjustment is not just one adjustment, it's actually two adjustments. An adjustment to taxable income and then the additional adjustment to your deemed dividend or deemed donation, depending on the nature of the taxpayer in whom that transfer pricing adjustment is made. So if we just have a look at this example, yes, okay, must all 5 prerequisites apply? Yes, the answer is yes, they all have to apply. So this example here, we've got a foreign parent company paying 65 million rand for goods supplied by an SA resident subsidiary. Okay, so the SA resident is getting the income, the foreign parent is paying, they've got the expenditure. So the SA resident records taxable income based on that sale of 65 million. But actually the arm's length price, it turns out, and this is much more complex than just stating it like this. I mean, how do you establish the arm's length price? But let's say the arm's length price was actually 100 million. So SARS will say, well, that SA resident subsidiary should have charged 100 million. They've actually charged 65. So that difference of 35 million becomes the primary adjustment. That will increase the taxable income of the SA subsidiary by 35 million. All right, so that's an extra 27% tax on that amount. All right. And then in addition to that, the SA resident subsidiary, SA Co, is deemed to have paid a dividend in specie. And that dividend is deemed to be paid 6 months after year end, by the end of the 6th month, after the end of the year of assessment. And that will carry dividends tax at 20% on 35 million. So an extra 7 million Rand tax. And you can't reduce that through a DTA. Okay, there's no basis. It doesn't allow for it in terms of the fact that this being a dividend in specie created under Section 31. Your DTA is not going to help you here. Okay, so you can see that it does result in a lot of additional tax liability here for this resident subsidiary. So something similar here happened with the ABD case, except it wasn't a supply of goods. It was the supply of intellectual property, and ABD, being now the holding company, but also SA resident, they were deriving this income of royalty income, and SARS said, no, you're not charging an arm's length rate. We are making this transfer pricing adjustment. Massive adjustment, huge increase in taxable income, and the additional dividends tax on this dividend in specie. All right, so the question was, how do you establish arm's length price? And as I said, SARS used 2 different experts in the course of trying to establish what should have been the arm's length price for these royalties to use the intellectual property. ABD themselves used a whole fleet of experts to try and establish the arm's length price. And they came up, basically all of them had their own method of establishing the arm's length price. Now, there's various methods. You can have the resale price method. I'm not going to go into all of this, otherwise we really will be here all day. But just to give you what they called: resale price method, cost plus method, transactional net margin method, comparable uncontrolled price method. That one I think is fairly self-explanatory. Transactional profit split method, willingness to pay, and role of brand index. These were 2 fairly novel ones that were used specifically in the case of ABD. So all of these, the last few, were all used in the ABD case. Not these first ones, those are recognized generally, but these ones were all considered in the ABD case. So it's like each different expert had their own method, to work out. It's like, how long is a piece of string? How are you going to establish that? What is the true arm's length price? Because you have to take so many different factors into account. And the key thing, of course, is what are you pricing? So here, what are you pricing is this royalty paid for intellectual property. And in this particular context, what would that royalty be? Now, interestingly, ABD just charged a flat 1% rate for the right to use the intellectual property, and it charged all the opcos, wherever they were in the world, they paid the same 1% rate. And as you can see, all of the experts jumped in and came up with all sorts of wild and wonderful ways of calculating what a proper arm's length royalty rate would be. And I don't have time to go into all the different things that they investigated. You can read the judgment if you wish to do so. The bottom line is the question was whether that represented an arm's length rate. In other words, what would the royalty be if it was charged between 2 independent enterprises in an arm's length situation? Okay, so if you went to somebody and said, I want to use your intellectual property, I mean, this is very difficult to do because it's highly unlikely anybody else is going to use the intellectual property other than the operating companies in that group. So you've got a bit of a contained situation in any event. But nonetheless, one has to do your best to try and establish what a truly objective arm's length value would be. And ABD was successful here, actually, in proving to the court that they had done their best. And actually, they said they have no reason to try and underprice this intellectual property. There's no reason for them to actually do that. It's not going to achieve anything for them. But in terms of the judgment, it was also pointed out just that issue around associated enterprises, that there was this aspect of control, all right? And so it was a controlled transaction. How to establish the arm's length price? Well, yeah, all of these different experts, 5 different experts, just at this point, never mind anybody else who got involved in adding their information along the way. 2 relied on the transactional profit split method. 1 relied on the CUP. Let me just go back here because my brain is too full of words at this stage. Comparable uncontrolled price method. And as I say, others relied on these aspects over here. One of the specialists used this role of brand index, which the court said it was completely inappropriate. So yeah, everybody has their own idea of how to establish that arm's length rate. But at the end of the day, ABD was successful in showing that that rate was as close to an arm's length rate as could possibly be. So their appeal succeeded. And I have to say that it's worth taking note of what was said in paragraph 114 of the judgment, where it was stated, I appreciate that the outcome of this case will be of great disappointment to SARS, which put into it extensive resources to create a precedent in the seldom litigated field of tax law. But this not only meant it running contrary to the opinions and approach of its initial expert, which meant effectively dispensing with his views without explanation and engaging a new expert, but fighting a case where there appeared to be no rationale for the taxpayer to have any motive to shortchange the South African fiscus, as was mentioned earlier, and I made that point a bit earlier as well. So at the end of the day, ABD was successful, SARS was unsuccessful, and they did say, sorry, SARS, we know that you must be disappointed. Well, I'm sure the taxpayer was quite relieved, but I'm sure this is not the last word we'll see in terms of transfer pricing. Anybody who's involved in cross-border transactions where there is a controlled situation, connected persons or associated enterprises, and be very careful of that definition, then just be ready to be able to defend the price that is being charged, whether it is for management fees, as the question came up earlier, whether it is for interest on loans, whether it is the amount of the loan that is granted, whether it is for the sale of trading stock, whether it is for royalties, whatever it might be, whatever kind of income and expenditure. Remember, Section 31 applies where there is any transaction, operation, scheme, arrangement, etc. So it has very broad application as far as that is concerned. But the idea is that there is this controlled transaction where the price could be manipulated. And the tax risk here is enormous. And, transfer pricing, I'm sure you're aware, is becoming, well, not just becoming, I would say even for the last 10, 15 years, has been an area of huge tax focus from the fiscus, the various tax authorities around the world, and then of necessity by the taxpayers themselves, because they've got to have the necessary documentation available to be able to discharge the onus upon them that their price is reflective of an arm's length price. Yeah, Ian, I'm glad you found this interesting. It's a lot of stuff to digest, isn't it? Because there's so many different things. So Ian says, it seems that a lot of tax is contrived, and that contrivance leads to ever-increasing complexity. And the worst offender was not included amongst the cases. Capital gains tax, that's another one. I'm sure we're going to see cases start coming out more and more on capital gains tax. Yeah, so tax is it's a fascinating area, extremely complex. And when you look at these different things, and I warned you when we started, I said that legislation is complex, and then you get to transfer pricing, that's complex. There's hardly a section of tax where you can say that it's not complex. I always get worried when somebody says, oh, it's a very simple matter. There's hardly ever a simple matter when it comes to tax, right? Okay, anyway, the good news is those are all the cases that we're going to be talking about today. So we can move on now to SARS documents and notices just for a few minutes. So I just wanted to point out to you that SARS has put out this guide on the solar energy credit, and they have updated it. I'm not going to go through the guide. I don't have time to do that this afternoon. But because we're moving into tax filing season, That's only in about, 4 weeks' time that we start submitting tax returns for 2024. I'll talk more about that just now. And you will have many individuals, no doubt, who want to claim the solar energy credit. And make sure that you've been through the guide, they've been through the guide, that you all understand exactly what all the specific requirements are for that credit. And very importantly, what documentation you must have on hand if you claim that credit in your tax return, because guaranteed, as soon as you submit that tax return, there's going to be a call for verification. So have those documents handy, otherwise you're going to think you've just gone on holiday to the Kruger Park or something, and now you've got to be running around trying to find documents for the call for information, relevant material for that verification. All right, so have a look at that guide. It's actually good. It's very comprehensive. It goes into many different areas as far as the credit is concerned, and really essential that you have a look at it. Okay. All right, then back to VAT. So SARS recently announced that they had got themselves ready to issue estimated VAT assessments. They announced this in December. And they said they will do this if you have a vendor who does not provide the relevant material requested by SARS during the VAT verification process. Again, exactly like what I was talking about just now with the tax credit. And I was saying, have your documents ready. And we know that SARS does VAT audits all the time, calling for relevant material. Let's say you've got a refund situation. They want to do a verification before they pay out the refund. They call for the relevant material. If you don't provide that by the due date, then they can go ahead and raise an estimated assessment, which no doubt would mean they will disallow your input tax and raise this estimated assessment. And then the only way that you can deal with that is to provide the outstanding material and then ask SARS to revise that assessment. Okay, so you can't specifically object to this assessment. You've got to provide the outstanding relevant material, and only then can you ask SARS to amend that assessment. So the raising of that estimated assessment creates a tax liability. All right. And then unless, you can get some kind of suspension of payment and you can provide the relevant material, ask for a reduced assessment, etc., it's going to become an absolute nightmare, because SARS can then go ahead and take steps to collect that tax that they say is owing. All right, so they have got quite a bit of information on that, a guide, links, and I've given you a link to the website here, giving more information if you want to have a look at that. And then the other aspect on VAT, going back to VAT apportionment, and of course in the Capitec case, we spoke about VAT apportionment, and we said that generally speaking, VAT apportionment happens in terms of Section 17 of the VAT Act, although in the Capitec case, their apportionment was not based on this section. It was an apportionment within Section 16(3)(c), which is the route they were taking. But where you are looking at claiming input tax, if the vendor is incurring expenses or they're buying goods or services in order to make both taxable and exempt stroke non-supplies, so you've got mixed supplies, taxable and non-supplies or exempt supplies, you can only claim your input tax, obviously, to the extent to which you are using your goods, services for the purposes of making taxable supplies. And so if you have a mixed supply, then you would have to do an apportionment. Although SARS does say in the guide for vendors that you would first try and do a direct attribution if possible. This expense for a particular supply, is that supply taxable or exempt? But if you can't do a direct attribution, if it's sort of general overhead expenses, then you're looking at apportionment, okay? And then the apportionment that you do has to be an amount which bears to the full amount of the tax, the VAT that you've paid on these expenses. You can only claim according to the ratio of your taxable supplies in relation to your total supplies. And the way that that apportionment happens is set out in SARS binding ruling number 16. And that was recently updated towards the end of last year. I've given you a link, I think, on a later slide. Yeah, we'll come to that link just now. So the standard method is the standard turnover-based method, literally saying what is your taxable supplies in relation to your taxable plus exempt plus non-supplies, all of your other income. But there are various adjustments that come in here. And when they updated this ruling towards the end of last year, it's these adjustments that they have worked on specifically. Which income comes in, like interest, dividends, etc. Does that come in or does it fall out? And so it's really important, if you are doing apportionment, that you have carefully considered the latest version of BGR 16 to make sure that you are still getting the right outcome for that apportionment. In other words, it must be a realistic outcome. If it's giving a totally incorrect or absurd result, then the vendor has to apply to SARS for a specific ruling to use some other method. And then bear in mind, we saw this in the Makuru case, I think of last year or the year before, where they applied for a ruling to use a transaction count method as opposed to a RAND-based apportionment method. But they wanted to go all the way back to when they started, which was about 2.5 years prior. But the law says you can only go back, if SARS allows, your ruling can be retrospective only back to the beginning of the year of assessment in which you applied for the ruling. But usually that ruling is only ever going to be prospective from the time that the ruling is granted. So if the standard turnover-based method is giving an absurd or incorrect result, you need to apply for a specific ruling. And until you get that ruling, you have to use the standard turnover-based method, even if it gives an absurd result, because that is what you have to do unless you get an alternative ruling. So the practical points is that if you've got mixed suppliers, remember that if your suppliers comprise, your taxable suppliers comprise 95% or more of your total suppliers, then you're okay, then you're regarded as making fully taxable suppliers. So 95 plus equals 100. But if you have exempt suppliers like Capitec had and taxable suppliers, then of course you've got to apportion on the basis of BGR 16. And SARS says they cannot rule beforehand on whether an expense is directly attributable to taxable suppliers. That's one of the things on the no rulings list. So if you need a ruling, if SARS basis, the standard basis, is not appropriate for you, then you must get a ruling, and timeously, because, as I say, that ruling is going to apply prospectively. You can't just go ahead and use your own apportionment without getting a SARS ruling. And also check that if there was a ruling and it has expired, that you get a new ruling. Also check BGR 16 to see exactly how it's going to apply to your clients, because maybe it has an unexpected effect on their calculation, which might mean that you have to now apply for a ruling, whereas before you didn't have to. It just depends on the makeup of the client's revenue stream. So the rulings that SARS has issued so far, and what they've done is since the beginning of this year, they now have created a new thing called a VAT ruling, okay? So the BGR 16, I've given you the link there to issue number 3, which was published in November last year. As I say, really important if you haven't done so already. And if you're involved in VAT and in apportionment, or even if you're not, and maybe you should be, have a look at BGR 16. But then you might want to just have a look at these VAT rulings, especially if you're in the financial services industry. Now, of course, these VAT rulings, they are all effectively binding private rulings. So they're only binding on the particular parties that applied for the ruling between them and SARS. But they are published in order to give information so that you can get an idea of what happened in that particular situation. I'm not going to click on them, but I've given you an idea of the context: private client, wealth management, stockbroker, holding company, investment company, etc. So you can click on these and have a look and see what the ruling is. But remember, that's not going to apply to you, and you can't even quote that. It has no application to anybody else other than the parties to that ruling. But it is published for information so people can see what happened in that case. And maybe you say, oh, my business is very similar to that. I need to go and apply for a ruling that's going to apply to my business. And maybe you'll see yours listed there one day as VR00 whatever. Okay, so those are the VAT rulings that have been published so far this year. Now let's turn to the third-party returns. Now, this season is almost all but over, except for trusts, because third-party returns, as published in this public notice in Government Gazette 48788, and that was on the 30th of June 2023, but it's still relevant. So it stays relevant until it's replaced by a subsequent notice. So these are third party, not your income tax returns. I'll come to those just now. So third party returns, it's like your banks, your medical aids and so on that have to submit information to SARS. And they had to submit that information by the end of May, okay? And so that's fed into SARS, and so that there's work going on behind the scenes. Much of that information is getting pre-populated onto our tax returns and so on. And that we'll then see all of that coming through when we do the filing season. But as far as trusts are concerned, they were given an extension that they only have to submit their third-party returns, the IT3T returns, by the end of September. And I've given you the link there to the public notice that amended. So this one initially said everybody end of May. And then they said, no, trusts you can have until the end of September. So the people required to submit, as I say, your banks, your medical aids, estate agents, etc. And then you see also Section 18A institutions had to submit the IT3Ds, and resident trusts, a trust that is a resident, had to submit IT3Ts. Well, they will have to by the end of September. So the 18A institutions, although this is probably, history now, because they had to submit by the end of May. And going forward, they'll have to make 2 submissions, end of October and end of May, just like all of the other third-party institutions, other than trusts, okay? But they have to submit basically all the information that they give out to a donor on the 18A certificate. That have to pull all of that together, and that's what has to be submitted to SARS. So they're then telling SARS, these are all the donations we received from all of our donors, with the amounts and the value, if it's an asset that was donated, and all of that sort of thing that would have to go onto that IT3D form. As far as trusts are concerned, so here's the IT3T, and I've given you a link there to the SARS website. And basically, trusts have until the end of September, and that'll be each year. So the year going up to the end of February, you have to submit your IT3T by the end of September. That has to declare to SARS and tell SARS about any amount that has vested in a beneficiary. Okay, so that includes income, net of expenditure. So like if it is rental income, remember that the deduction of expenditure follows the income. So you've got your income, net of expenditure, capital gains, and capital amounts. So that's what you have to report to on your IT3Ts. Okay, I think everyone is aware of that by now. I know there's been a lot of discussion in various fora around that, but I think everyone understands that for trusts, it's the end of September. So let's go on to the latest public notice that was in the Government Gazette. Well, the latest one was the 7th of June, and that was amending the one that came out on the 31st of May. And the main notice is the one of the 31st of May, telling us who has to submit tax returns in the 2024 filing season. So for years of assessment, for individuals, years of assessment end at the end of February 2024. But the thing is, they got just some of the numbers, the tax thresholds were the old thresholds that they used in the notice on the 31st of May, so they had to amend that. Okay, but that's the only thing that's changed. So what I have on my slides here is the combined version of these 2 public notices. Now, SARS obviously always has their tax season web page, and I've given you a link there. I'm sure they'll update that as we go along. But the key thing is who has to submit a tax return. I'm going to go through this extremely quickly, but I just want to make you aware of this notice. There's not really anything that has changed. Well, there's maybe 1 or 2 small changes I'll point out to you. But in terms of who has to submit a tax return, it's pretty much in line with what we have seen in previous years. For the 2024 year of assessment for a company, it's any year of assessment that ends with a 2024 at the end, whether it be January all the way through to December, sometime during 2024. For anybody else, it's a year that ended 29 February 2024. And then who has to submit? So when we talk about companies, we distinguish between resident and non-resident. That's in terms of our Section 1 definition. Resident companies, it's not just a case of were you trading. Okay, it talks about how much gross income, all right, not taxable income. If you have gross income of more than 1,000 Rand, or you held assets or had liabilities of more than 1,000 Rand at any time during the year, or you derived a capital gain or loss of more than R1,000 from the disposal of an asset in terms of the 8th schedule, or, and here, so even if you have no gross income, no capital gain, no assets even, but if you have an assessed loss or assessed capital loss brought forward from the previous year, you would have to submit a tax return. They also refer to taxable turnover because turnover tax submissions for micro businesses are also covered by this notice. For non-residents, if they carried on a trade through a permanent establishment, or they had income from a source in the Republic, or again, if they had any capital gain or loss from the disposal of an asset to which the 8th schedule applies. Now, for non-residents, the 8th schedule applies to immovable property in South Africa, or any asset effectively connected to a permanent establishment in South Africa. All right, so in that case, any capital gain or loss, any income from a source in the Republic, or if they even just carried on a trade through a permanent establishment in the Republic, companies, trusts, and any other juristic persons who are non-residents, they would have to submit a tax return. In addition, if you have a non-resident company that was incorporated in South Africa, but has become a non-resident through the application of a double tax agreement, and that would happen if your place of effective management is actually outside South Africa. And in terms of a double tax agreement, that company is now deemed to be exclusively a tax resident in the other country. So they were incorporated here, they're exclusively tax resident there under the DTA. And that means in terms of our definition of resident, they're not treated as a resident, they're excluded from the definition of resident. But because they were incorporated, established, or formed here, they still have to submit a tax return. So you can see that it does go broader than just what many people seem to think at a superficial level. Trust, any trust that was a resident, and for non-resident trusts, as I pointed out over here, carried on in trade, income from a source, or capital gains or losses. Resident individuals, well, this is pretty much the same as what we've seen in the previous year. If they carried on a trade, capital gains or losses exceeding the annual exclusion. Notice here, even if you have none of that, but you just have foreign assets that exceeded 250,000, the rand value, at any time during the year of assessment, that would cause you. So any of these things, is all this or that or that or that, any one of these things would require a person to be obligated to submit a tax return for 2024, unless you are excluded under paragraph 3, which we'll come to just now. All right, so it's your assets, your foreign assets. If you have income or capital gains that are deemed to be received by or accrued to you under Section 7, or they're attributed to you under paragraph 68 to 72 of the 8th schedule. So that's where there's a donation aspect involved, where a person makes a donation as a result of which income flows to somebody else, but Section 7 deems that that income has been received by the donor. All right, so in that situation, the donor has to submit a tax return. But this is talking about income or capital gains from funds in foreign currency or assets outside the Republic attributed to them. All right. If you have an interest in a controlled foreign company, or any taxable turnover if you're a micro business, or you had gross income over the tax threshold, and these are the amounts that they had to amend because they were using last year's tax threshold. So this is the tax threshold for people under the age of 65, under 75, so 65 to under 75, and then over 75. All right, so those are the various tax thresholds. So gross income. So although tax threshold, we normally say if your taxable income does not exceed this amount, then you won't pay tax. This is not taxable income. This is gross income. Gross income. So interest plus dividends plus rental plus whatever that comes into gross income before you take off your exclusions, before you take off your deductions. Okay. If your gross income exceeds the threshold, you have to submit a tax return. So any of these things would trigger the submission of a tax return unless excluded under paragraph 3. And paragraph 3, the exclusion, and I'll just leave non-residents for now. I'm sure you can have a look at that in your own time. But the paragraph 3.1 exclusion So if you are someone who would be required to submit a tax return because of these requirements over here, which kind of is all embracing if you think about it. However, if your gross income was derived only from something that falls into one of these 5 boxes, so you don't get any gross income other than what falls into one of these 5 boxes, then you're not required to submit a tax return. The first box is remuneration from a single employer, not exceeding 500,000, PAYE, has been correctly withheld, and it's not remuneration from a subsistence, travel, or public officer allowance. Because if you get any of those allowances, or you get a company car, then you have to submit a tax return. The exclusion is not going to apply to you. Notice also that if you got all of your remuneration from one employer, paid the correct amount of employees' tax, but you worked outside South Africa, so you got any amount in respect of services rendered outside South Africa. You might work for an employer in South Africa, but you render your services outside South Africa. So if that is the case, you have to submit a tax return. That exclusion, even though you haven't gone over the 500,000, etc., you have to submit a tax return nonetheless. All right, and then SA source interest over the threshold of the exemptions. Notice this one with dividends. Dividends, if you get dividends, local dividends that are exempt under Section 10(1)(k), if you're a non-resident, then those dividends fall into this box. But if you're a resident, they don't fall into this box, then that means you have got gross income that doesn't fit into any of these boxes. That means you would have to submit a tax return. Okay, or any amount from a tax-free investment or a single lump sum from a retirement fund that was taxed according to a SARS directive. So you've got any kind of income other than this, then you would have to submit a tax return. Okay, because this exclusion is not going to apply to you. So if you fall into one of these categories and the exclusion doesn't apply to you, then you would have to submit a tax return. Now, of course, there's also the auto-assessment exclusion. So if SARS auto-assesses you, you get the auto-assessment, you have to check it, and if it is 100% accurate, then you don't have to submit a tax return. But this exclusion only applies if it is complete and accurate as reflected on SARS auto-assessment. So if that's not 100% accurate, then you are obligated to submit a tax return. You do have to submit a tax return, and you'd have to submit that by the deadline date. All right, and then of course the others are your deceased estates and anyone who is notified by SARS that they have to submit. Let's just get quickly to the deadline dates. So companies have to submit by 12 months after year end. Individual taxpayers, if they are not provisional taxpayers, as defined in paragraph 1 of the 4th schedule. So you've got to say, was this person a provisional taxpayer for the 2024 year of assessment? Okay, not were they for the last 20 years, because it can change year by year. For the 2024 year of assessment, was this person factually a provisional taxpayer as defined? If not, their deadline is the 21st of October. If yes, their deadline is the 20th of January next year. And notice all trusts, we don't distinguish for this deadline, we don't distinguish between provisional or non-provisional, because yes, some trusts might not be provisional taxpayers, okay? But whether you are or you're not a provisional taxpayer, if it's a trust, your submission date is 20th of January. So that's different to previously. Previously, with trusts, we had to differentiate between provisional and non-provisional. So what will happen is from the 1st to the 14th of July, SARS will start issuing auto-assessment notices. Just by mere fact that you get an auto-assessment doesn't let you off the hook. You still have to check that that is correct. And if it's not correct, fully accurate and complete, then you still have to submit a tax return. All right. So it's important to know that, because SARS will levy non-compliance administrative penalties for people who don't submit tax returns if they were obligated to do so. And of course, if somebody has been levied a penalty by SARS, they need to check, were they actually required to submit a tax return or not? If they were really, in terms of this notice, not obliged to submit a tax return, they were excluded, then SARS cannot charge them a non-compliance penalty because they are not non-compliant, all right? So it is important to understand who has to submit and who doesn't have to submit. Let's just have a look at the questions. I see a whole lot popping up here. Must the IT3T be submitted even if no vesting or distribution of capital assets in the year? So from what I can see there, and I think, look, we do still need to get a bit more clarity from SARS on this IT3T. But what it says here, if we go back to this, and this is basically from the public notice, is it says what you have to report is any amount vested in a beneficiary. So if there's no vesting that's happened, that particular reporting would not have to take place. How do SARS know whether a company has assets, etc.? The reason I ask is SARS sends me final demands for companies that have been dormant for years. Yeah. How do they know? Well, look, if they are sending you final demands, then you would need to provide them with information confirming that these companies have no assets. Because remember, if they have assets or liabilities exceeding 1,000 Rand at any stage during the year of assessment, then they have to submit. So, if they have no assets, no income, no capital gain, no assessed loss or assessed capital loss, then they don't have to submit. So then I would suggest you'd have to write back to SARS and clarify that the person is not liable to submit because they've taking into account what's in the public notice, they don't fall within the scope of that requirement. And then you might need to have some way of proving that to SARS. So I don't think they necessarily know for sure, that maybe you need to confirm that with them. Are you able to correct an auto assessment before the 15th of July? Look, I think this is going to become pretty evident when they start with the auto assessment process. I would imagine that you would be able to do that. If they issue you with an auto assessment on the 1st of July, they say that you can't submit tax returns until the 15th onwards. It might be possible to auto-correct, but I can't say for sure until we start with the filing season, or somebody from SARS would have to confirm that. If the taxpayer is no longer a provisional taxpayer for the 2025 year, do you submit the 2025-01 or we don't submit? Because, okay, so look, your obligation to submit an RP6 is if the person is a provisional taxpayer for that year. All right. So if you know for sure that the person is not going to be a provisional taxpayer for that year, then you have no obligation to submit the first provisional return. Okay, so then you just would not submit because the person is not a provisional taxpayer. But just be careful because, if things work out that by the end of the year he is a provisional taxpayer, then he is a provisional taxpayer for the year. And then SARS will say you should have submitted a first provisional. So just be quite sure on that first. But if you're quite sure they won't be a provisional taxpayer, then you would not submit the provisional tax return. Okay, I don't see any other questions there. So I think that brings me to the end. A lot to digest. Been bombarding you for 3 hours. I'm glad Stan very kindly said I'm going to entertain you for 3 hours. I don't really think it's terribly entertaining, but it's informative.
Mind boggles.
All right, but thank you very much, Stan. Back to you.
Thank you very much, Jackie, and thanks everybody for attending. Your certificates will be on their way. Next month, there's a session on the 25th of July on exchange control. I hope that you enjoyed today's session with Jackie. As always, it is entertaining, although mind-boggling. And at the end of the day, bang your head against the wall.
Yeah.
Yeah, so thank you very much, and I hope you enjoy the rest of the afternoon. Danny, I don't know if there's anything you want to say.
No, nothing from my side. Thank you again, Jackie. It was very informative. Yeah.
Yes.
Maybe not entertaining, but it's always informative.
That's good. That's
okay,
good.
Maybe that's a better word.
Yeah, well, thanks very much, everyone. I hope you enjoyed the session, that it was informative and valuable. So thanks very much, and enjoy the rest of your day as well.
Thank you, and thanks everybody for attending.
Thank you.
See you.